We're live.
We're live, ready to rumble. There you go. How are you?
Let's do it. I'm fine. How are you doing?
Excellent, excellent.
Good,
Very
good.
excited to have you here.
I'm honored to be here today. Thank you for inviting me.
Of course, thank you for coming.
It's a pleasure.
So this is our good friend Phil Atwan, and he's been with Exchange Resources Inc. for about 25 years.
One of the founders.
One of the founders.
Yeah.
And he's actually an expert in 1031 exchanges, which is a very, very important tool today to safeguard your money that you've worked so hard for. And so without any further ado, please tell us a little bit about what a 1031 exchange is and how it works, please.
Pablo, thank you, and good morning to everyone who's watching this feed today. A 1031 exchange was actually something that Congress created all the way back to 1921.
Okay.
The purpose of the exchange was for investors or business users to take their properties and to be able to sell them, acquire better properties other places for the purpose of expanding their business. They can do this on a tax-deferred basis. This is not tax-free. Tax-free is you sell the property like your principal residence. If you qualify for what they call the 121 principal residence exclusion, then what they do is they exclude gain up to $500,000 to a married couple, up to $250,000 as individuals.
Okay.
And they allow you to do that one time every 2 years if you qualify for the 121 principal residence exclusion. That's like a wipeout of gain. This is not a wipeout. This is not a forgiveness. What it is a deferral that allows you to bring all your capital gains taxes and all the other taxes that you pay, because there's more than one tax when you sell a piece of property, into an acquisition of a replacement property, property that will allow you to continue a business or a source of income like rent. And the government will let you do this until you die. And when you die, if you set up your estate properly, as an example, like a trust, then your heirs will receive it at a what they call a stepped-up basis. That's another thing that Congress did. The government did in 1954.
Okay.
In 1954, if you set up your estate in a manner of which you'll have to talk with an estate planning attorney to do so. So let's say, for example, you bought a property once upon a time for $100,000.
Okay.
And whether it's appreciated to $1 million or whether you've done some sales and re-leveraging of that property into other properties through a 1031 exchange, whether you did or not, your estate is worth, at least in that respect, $1 million. When you die, your heirs would inherit your tax problem. You bought it for $100,000. It's worth $1 million. You have a $900,000 roughly capital gain.
Right.
You'll have to pay taxes on that money. Through this, in 1954, the stepped-up basis rule, they allowed in most certain situations that your heirs will receive the property not at the $100,000 acquisition price. We call that in our industry an adjusted basis. But what happens is they will receive it at the value at the date of death.
Right.
So they can literally turn around and sell the property and be done with all capital gains taxes. And we call that in our industry swap till you drop. So you keep exchanging until you pass away, so your heirs will get the property. The government did that in 1921 for the exchange and 1954 for the stepped-up basis.
Okay.
Why? Because real estate generates taxes. Real estate generates the people selling and buying, which generates more industries coming into the fold of this sale and acquisition. And when people make money, they pay taxes. They work. Then they go out and spend money. And then they stimulate the economy for other businesses because they were able to transact. This goes on
And on.
and on.
Yeah.
And it just touches so many people, and it affects the government in such a positive way. I mean, right now we have, unfortunately, the 2024 budget that was proposed by the White House that was given to the Congress, and they want to reduce the amount of 1031 exchanges to $500,000 a gain. Personally, I don't think it's going to happen. I don't think the Congress will vote for that. It remains to be seen. I was just speaking to somebody the other day, and they mentioned that, back in the previous administration, things were changing so fast, especially the accounting industry had to study and evaluate and make those changes to make sure that when they were filing returns, they would be, acceptable to the IRS and in California Franchise Tax Board. Now they haven't had to do a whole lot because nothing's getting passed.
Yeah.
Even though they're proposing a lot. But I don't think it'll pass, but we'll see what happens.
So go ahead.
If I may, just to bring it back real quick. So it's not tax-free. A 1031 exchange is not tax-free. It's a tax deferral.
Correct.
But in the situation you gave, if there's a trust, the children that inherit all this property are going to essentially get it almost tax-free, but it's not tax-free, right?
Well, it's the basis is stepped up. The basis is what you paid for the property.
Right.
So if you paid $100,000, it's worth $1 million. And when you pass, it goes to your surviving spouse, kids, whoever your heirs are, through this vehicle like a trust, or if the trust is the shareholder of your LLC that owns the property, will get a stepped up basis.
Correct.
They have to go speak with their estate planning attorney and their CPA to make sure that everything is jiving the right way. But if they do that, they'll swap till they drop, and they'll take that gain with them. They'll take that original basis that keeps getting adjusted as they go into bigger and better properties with them. The gain doesn't go away until you die.
Right. You
If
can't
you have
cash
it
out.
set
You
up.
can't sell it and take
You're
that
going to
money
go
out.
back and pay taxes from property number one.
Right.
Exactly right. And that's a beautiful thing. And that's why the 1031 exchange is so powerful, because corporations, individual investors who own rentals, whether it's condominiums or single families or multi-family residential or whatever, I mean, they're all utilizing 1031 exchanges for various reasons, of which I'd be happy to get into in this podcast today.
And so it's a deferral of taxes. And then what ends up happening, correct me if I'm wrong, if you end up using it and you buy another property, that second property has to be worth more, right?
Equal or greater.
Equal or greater than the first one.
Right.
Okay,
That's correct.
that's correct.
And all the cash from the sale must go into the acquisition. So if you buy equal or greater but hold back cash, you'll pay taxes on the cash that you held back. The purpose of the exchange is a trade, an even trade, or it allows you to re-leverage to go higher. So if you're not doing that, by virtue of the fact that you're getting this tax benefit to do so, then you pay taxes on the difference.
And
so
the
you can even
difference
buy
is-
it for more, but if you keep some of the cash, you pay taxes on the cash you keep.
Okay, and in your industry, that's considered boot?
Boot. There's two kinds of boot. There is cash boot, of cash you retain
Okay.
that does not go into the acquisition. There's also something called debt relief boot. Well, what's debt relief? Debt relief says that I'm selling the property for $1 million, and I currently have left of loans on my property. A first, a second, a HELOC, a line of credit, hard money, whatever, that have to be paid off. The government says you have to go into an even trade. So if you sold for $1 million, you have to buy roughly for $1 million. All the cash needs to go into the acquisition. But how do you get back to that $1 million? The answer is you have to reborrow the debt.
New debt.
Or bring in new cash into the acquisition to replace the debt. The government will accept either one. So there's no debt relief boot, there's no cash boot, and you've traded what you have sold into something or multiple properties, which are now better for you and your business or your income or whatever it is. And we're going to get into those Those three main reasons why investors do this.
Okay. And how about the time frame? For example, if you can tell us a little bit about the time frame. For example, you have to identify property certain days after the close of the escrow. Can you get into that a little bit for
Let's
us?
back it up just a little bit
Okay.
so we can cover the whole gamut.
All right.
What happens is if this 1031 exchange makes sense for your client or you, what happens is they need to bring in what they call a qualified intermediary. That's what the IRS calls us on the street.
Okay.
They call us accommodator, facilitator,
Okay.
and lots of other names that I can't repeat on the podcast. No, I'm just kidding.
But that's what you are.
Yeah, that's what some people might think. But the bottom line is that we have to set up the exchange while the sale is in escrow.
Right.
So we set up all the necessary document with the help of the escrow officer here. It could be a title company's escrow division, or in other states, they're what they call attorney states. And those attorney states, those attorneys handle all the escrow.
Right.
So we have to set up whoever that is, wherever that is, with our documents that assigns us into the contract, which is step one for the seller to do the exchange. Once the sale closes, Pablo, like you just mentioned, there are timing deadlines that the federal government mandates under what they call a delayed exchange. A delayed exchange says you're not going to close your purchase simultaneously. You may at the same time, but most people will not do that. They will close their purchase at a later date. How far into the future later can that be? The answer is you have 180 days to close the purchase. It's based on the closing of the sale, the next calendar day, not business day. There's no business days. The next calendar day is day one of 180 days. So if we close on a Friday the 3rd, Saturday the 4th is day one of 180 days. And a lot of people say 6 months. That's wrong. 6 months is 2.5 days longer than 180 days. So we don't want anyone to be confused. Why? Because if that 180th day lands on a weekend or a holiday, when the county recorder is not open, the title companies are not open, the escrow companies are not open, and the accommodators are not open,
Failed exchange.
you have a failed exchange, which means you go and pay all the taxes. So you have 180 days in which to close your acquisition, no longer. There are no extensions to that. There's a couple of exceptions, but for the most part, there are no extensions.
Right.
Number two, the first 45 days of that 180 days, you must officially nominate under the 3-property rule up to 3 different addresses, specific addresses, non-generic. In other words, they have to accompany a unit number if it is applicable. If you're not buying the entire property or you're buying just a fractionalized interest of the property, you have to identify what that fractionalized interest is. If it's unit B, like boy, then it would have to be identified that way. If you're going to acquire
Is that still
with other people, then you would have to nominate that address with your percentage of the ownership.
Oh,
of
so
that.
you can exchange and go into a partnership.
Yes. Well, we don't want to use that word partnership.
Oh.
That means something else as far as the government is concerned.
Take title.
We'll say title is tenants in common with other people that you're going to co-invest with.
Got it.
That's a better way of putting it.
Okay.
Government will misinterpret partnership for something else.
The words
There's
are
a
so
partnership
important.
interest that is not exchangeable, but we can go into that another time.
So, prior to, you mentioned you love speaking on this topic. You're very passionate about it. You do, how many speaking engagements would you say a
Between
year?
120 to 150 every year for the last 25 years.
150 every year for the last 25
120
years.
to 150.
Yeah.
So you are,
Pandemic, I had a little bit shorter at the beginning, but then they invented something called Zoom.
there you go. So you're a specialist, an expert at this exchanges, and you don't only do them in California, correct?
We do this nationally.
Nationally. So can you explain how it differs in California versus outside of California, other than, let's say, the escrows situation?
Good question. This is a code section 1031 of the Internal Revenue Code. That tells me right now it's national. It's a federal code.
Okay.
So you could exchange property out of California into any U.S. state, including Hawaii and Alaska, because they're still states. But in some rare cases, I won't say rare, but unusual cases, the IRS will allow you to go into a U.S. territory. For example, Guam, Puerto Rico, U.S. Virgin Islands. That can happen either from U.S. to there or the other way around. But that's it. If I was selling property in Mexico, for example, or Brazil, I cannot exchange it into the United States.
Right.
Because it has to be domestic for domestic. But the government does allow foreign for foreign. So if I was selling a property in Brazil, I can acquire a property in Abu Dhabi. We were just talking about that. And the government will allow me to do foreign for foreign exchanges.
Which government?
U.S. government.
Because I'm creating a federal tax return. As a U.S. citizen, I have to declare all my foreign assets on my tax returns. Now, some people say, well, I don't have to do that. Well, that's tax fraud, and maybe they need to have a discussion with their CPA, or their CPA is saying something that's out there. I do this continuing education, by the way, for the tax people, the CPAs and the EAs and the accountants. I also do it for the tax attorneys. So trust me, you have to report everything.
you have to. Whether some people do or not, that's another story.
Right.
Right.
Watch out if government finds you.
Yeah. That's right. Excellent. You know, the term like for like, I've had a couple discussions with friends, you know, and they say, oh no, you can't sell a house and buy a commercial building, or you can't sell a house and buy an industrial building. And can you elaborate on like for like?
Yeah.
If you have a house that's being rented, that's considered a business. So that would be, you can take the assets from that and buy commercial, industrial. Is that correct?
Good question. This is the most misunderstood part of the 1031 exchange.
The like for like.
I literally got a text this morning on the way up, and I don't text while I drive, so I called the guy up. and I got him straightened out on that, and now he's happy. So here's the deal. The government says you may only exchange one kind of property.
Okay.
And that's called investment real estate. But here's lies the important question. How do you define that? Because people think their homes are investments. People think that their second homes or their vacation homes are investments. Some people think vacant land is an investment. The question is, how does the government define investment? Because you have to do it their way, right?
Right.
So here's the deal. The first definition of investment is a property you rent out. And renting it for 24 months, now, you know, it could be a vacancy here and there, you know, that kind of a thing like that. But once you've had it for that 2-year period or 24-month period, and by the way, you declare the income on your tax return.
Right.
People call me up and say, yeah, I'd like to do a 1031 exchange. And I said, not a problem. Just, if you don't mind me asking, have you rented the property for at least 2 years? Oh yeah, we've rented it longer than 2 years. And you do declare it on your Schedule E or on your tax return. No, we don't do that. I said, oh, so basically what you're asking me is that can I do an exchange and defer taxes while I commit tax fraud on this property by not reporting that it's an investment piece of real estate? They're going to have to answer to a higher power than me. But the bottom line is that if you qualify for an investment, that means you're renting it out for at least 2 consecutive years to anyone. If it's a relative, like a related party, then what happens is the government requires, in fact, the CPAs will tell you, in most cases, they want to see at least 85% or greater of fair market rent.
Right.
Because if you're not, then it's considered a second home, and second homes are not exchangeable.
Nor your primary home, correct?
Your primary home is not.
It
No.
has
Ever.
to be a rental property.
Or the second definition of investment real estate, the government defines it as productive use in a trade or business. So whether you have an almond farm or a cattle ranch or a commercial building, or you utilize it as an office, however you use it for your business. If you do that for 24 months or 2 years, that means it is allowable and accepted because you declare it on your tax return as investment real estate and allowable for a 1031 tax deferred exchange. So the first one is rent. The second one is to utilize in your business. And there's one more definition of what investment real estate is as it relates to like kind, which we'll get to in just a second. Vacant land that you hold for appreciation. If you're holding a property for the sake of its becoming more valuable, and lots of us wish we had bought vacant land, especially in cities with the last name of beach, like Sunset Beach or Huntington Beach or Laguna Beach or Newport Beach or Manhattan Beach. I can go on and on about that. But even if it's not at a beach, that land go up in value over time. As long as you've been holding it at least for 2 years, it's now exchangeable. So those are the only 3 properties.
Yeah, because land doesn't necessarily produce revenue, but it falls
right.
under the exception.
Right, but it could be used just for holding, or if you have avocados planted, trees all over the place, or vineyards, or whatever they have, almond tree, you can utilize as productive use in a trade or business.
Okay.
Like farmland or ranch land. So the bottom line is these are all 3 acceptable definitions. Now, what is, to your question, a like kind exchange? So if I'm selling commercial real estate that I've either utilized, maybe it's a warehouse, maybe it's a factory, maybe it's an office building, can I exchange that into a single family rental? Is that like kind? The answer to that question is yes, it is. Because you're going from investment real estate, which is one of the 3 definitions, right, for productive use in a trade or business, into rental income property,
Okay.
which is also a definition of investment real estate. So you can go from vacant land to commercial to residential in any which way, as long as we have those 2 years of holding into any one of those properties. So it gives you the opportunity to change directions in the types of properties you own. And like you asked, you can exchange into any part of the country. So you can be done with residential because, maybe your hair is my color and you're tired and you don't want to be a landlord anymore, but you can go to a triple net property where maybe Trader Joe's or Chick-fil-A or Home Depot or I mean, you can go on and on and on with all these triple net tenants you can have, or you could even go into what they call a DST, D for the word Delaware, the name, S for statutory, like law, and T for trust, where you could exchange into a very large multi-million-dollar property, but you don't buy the whole thing. You buy a fractionalized interest as a tenant in common with other owners. The government will allow for that as well. So you can mix and match and change your lifestyle, change the types of properties you're in, change the locations you're in, run your restaurant business out of it, anywhere in the country.
It's very interesting you say that because some people say, I don't want to exchange, I'm done being a landlord. But maybe they don't know that's an option. Delaware Statutory Trust.
Right, or a triple net where,
Or a triple net.
they have a property that they don't want to babysit anymore. CVS is going to be a great tenant.
Yeah.
They're going to pay their rent, their lease payment. You don't have to chase them. And the other benefits of a triple net, whether it's through a DST or just a single triple net that you own, they tend to pay all the property taxes. That means I don't have to do that anymore. They pay for the insurance on the building. I don't have to take care of that anymore. They keep the building up to date and repaired, take care of the maintenance. I don't do that either. It's an incredible way to move your investment properties around so they work for you so you don't have to.
Right.
Make sense?
Yeah. I love
Isn't
the
this thing,
explanation.
I don't know how I sleep at night. I mean, it's amazing. It's very exciting.
Oh, it is. And this knowledge getting into my generation, and you've talked about exchanges, you've done them for yourself and with events. You've worked with Phil on them.
We're in one right now.
Right.
That is correct.
So thank you for coming out, by the way,
I'm honored to be
sharing this. What are your thoughts on a reverse exchange? Is it something? What do you think about it? Can you explain it to us?
Yes, the word reverse means backwards. So instead of selling and then buying, the government will let you buy and then sell. Now I get people who call me up and say, I was told by my real estate agent, because I bought another property first and now I'm selling this, I'd like to do a reverse exchange. And that is not a reverse exchange. A reverse exchange, like a delayed exchange, is you have to bring in a company into escrow to set it up. So
before purchase,
before closing of anything, we always, as the facilitator, example, Exchange Resources, needs to be a part of every escrow that's going to be involved in this exchange. You can sell multiple properties to buy one. You can sell one to buy multiple properties. However you want to do it, whether you're closing the purchase first in a reverse exchange, or a delayed exchange, or even simultaneous closing, we have to set up our paperwork in each escrow company.
Correct.
And if anything closes without us putting documents into it, and there's no backdating because that's tax fraud.
Right.
So the bottom line is we need to be involved at least 2 weeks before any closing of any property. So a reverse exchange is we set up the purchase as the closing of your replacement property, but in that situation, the federal government mandates that we either hold title to the one that you are buying, or before you close the purchase, we will take title to the property you're selling. Why? Because they don't let you buy from yourself. So if you take title to a purchase and then later sell and say, I'm going to exchange into the property I already own, you can't buy from yourself. It's off limits. It's tainted. So what happens is we have to set up a holding corporation to either take title to the purchase or take title to the sale property before the purchase closes. And then we could only hold the property that we're holding, either or, for a maximum of 180 days, which means the sale must close within the allotted 180-day period from the time we've taken possession of one of those two properties.
But
why would someone do that? Sorry, go ahead.
No, go.
Why would someone do that? I was thinking.
There's lots of reasons. Now I'm going to use the knock. Everybody hear that?
Yeah.
That's called opportunity knocking on your door. What if you find an incredible property, right location, right price, or there's so much competition for properties out there due to inventory shortages that you've got a chance to secure the right property and take care of that first and then close your sale. A reverse makes total sense. But here lies the issue. Where's the money going to come from if you haven't closed the sale? So you're going to either have to pay cash for the property or some cash plus get a lender involved, whether it's a swing loan, a bridge loan, a line of credit, hard money, or new purchase money. And then when the sale closes, anything that you had to advance for the acquisition is allowed to be reimbursed
Back
to you from the sale. And if there's any additional cash that's left over, we will work with the title company and the escrow people to do a principal pay down on the new property's loan.
So
Thank you.
reverse exchanges are not that common, right?
Yeah, 10%.
10%. Most of the exchanges are delay exchanges.
Correct.
Which is you've got a property you bought 30 years ago, you end up opening escrow. We contact someone like you to say, hey, this person wants to do an exchange because the basis is tremendous. So
The basis is low and the gain is high.
Right, the base is low, gain is high, and they want to get into something else. So prior to that close of escrow, we bring someone like you, we identify everything, and then escrow closes, and you got 45 days to identify 3 properties and 180 days inclusive of those 45s to close, to make that 1031 exchange viable in the eyes of the IRS.
Yes, and then your CPA will file an 8824 form in the year that you do the exchange. So, because escrow will issue a 1099-S form that
Okay.
it was set up with an accommodator, and then the IRS is on notice, and then you follow up with the tax return showing that you did the requirements that you just so eloquently explained, Pablo, and they will confirm that with the 8824 form.
So the reason I put it that way is so that our listeners can see what is the one that is mostly happening, which is a delay exchange in the time frame and so forth, and then you identified 3 properties within 45 days. What happens if the 3 properties that you identified in those 45 days, something happens and falls off or something? Can you replace it with another property?
You
Or-
can do that 100 times as long as you have not passed day 45.
Okay.
You can substitute and resubstitute. I tell people, wait towards the end because you're going to get confused what's on that list and what's not on that list because you have to document it.
Wait
with
till
us.
the end of the 45 days?
Right. Or
Okay.
get close to it.
Or get
And
close
then if
to
you have to make one more change, it won't be that difficult because you can change it as many times as you'd like before the end of day 45.
Okay.
Now, is there another way instead of the 3 property that you're able to do it where it's like based on the amount?
Yes.
How does that work?
That's a good question. The IRS gives you an election. For example, in November, we have an election, one running for this, one running for that. We have an election as an exchange investor to go with either the 3 property rule, where I have 3 addresses up to 3 addresses listed with no regard to value. What that means, if I'm selling for $1 million, I can put in $30 million identification properties. There's no limitation of value, just a limitation of 3 addresses. The option, the other part of the election, is what they call the 200% rule. The 200% rule says you take the gross sales price of what you've sold for. Let's say it was $1 million. 200% of $1 million is $2 million. Under the 200% rule, you now may identify 4 or more properties with its appropriate fair market address. Then you have to add all the properties' values together that cannot exceed 200% of the sales price. If you go over the 200%, you have 2 options. Number 1, they disallow the exchange. That's not a good option because we haven't even gotten into taxes in terms of how much this is going to cost you if you don't do this. Number 2 is you acquire at least 95% or greater of all the value you identified if you exceeded the 200%. So my suggestion is, if you can't add really well, use a calculator because you do not want to exceed that 200% mark. And I've seen the Franchise Tax Board go after people.
Oh.
The IRS has, but the Franchise Tax Board is worse. Honestly, if you were going to be in the ocean with either a shark or in a river with thousands of piranha, I think I'd take my chances with 1 shark than I would with 1,000 piranha. And that's the difference between the federal government, the shark, versus the piranha. That's called the California Franchise Tax Board.
Woo. So
if you don't believe me, just ask a CPA. They'll tell you what I just told you.
Okay.
They will verify that for the most part. So the 200% rule is a good identification if you need to buy lots of little properties in other places. So if you're going to sell in California, you're going to buy in Alabama. Well, they probably don't cost as much as they do here.
Right.
So for you to buy equal or greater in value,
Right.
you might need to exceed 3 properties.
3, that makes sense.
Yeah. But if that's not the case, you really need to stay with the 300% rule. That's my
You
personal recommendation.
explained it so well for me that I'm still learning this, and we're gonna link in the description all of the way that the viewers can contact you if you're okay, whether it's for speaking engagements or for your services or both. What's a really unique situation that maybe you can share with our viewers that you saw the exchange utilized to like just perfect, like it was done perfectly, and it's almost like the perfect situation of an exchange?
That's a good question. That's why people do reverse exchanges.
Okay.
Because they don't want to have that 45-day deadline, and that's going to push them in some cases. It's like painting yourself into a corner. You don't want that. You want the right property. So I think the key to a successful exchange is knowing where you're going and what you're looking for. Because it's not about what you're selling. It's about what you're buying and what you're planning to do with that, whether it's to utilize it in your business as business use or to create more income. What's the motivation for doing this? It's threefold. Number one, and by the way, I speak to this not because I've been in the industry for more than 41 years now, and I'm not saying this because I've been doing exchanges for 25 years. The reason why I'm going to say what I'm going to say is because I am an investor. My wife and I always have our eyes open. This is what we look for. Number one, income. I want the property to work for me so I don't have to. If I have a single family or a single commercial or industrial building or even a condominium, I can get one paycheck every month based on lease or rent payments. If I have 4 front doors, 2 duplexes, a 4-plex, 4 single families, whatever, 4 commercial buildings, I can expect a paycheck every week in an average of a month because I have 4 front doors. If I have 30 front doors, I can expect a paycheck every single day on average in a month. That's why people buy investment property. That's what they need to be looking for if they're looking for income. But there's 2 sides to income. One is called cash flow, and the other side is called rate of return off the equity. And my question is, since most of your listeners already understand cash flow for the most part, you get a check and you pay the bills, that's cash flow. But what's rate of return? So my question is, based on the amount of equity you have in the building, what are you getting back in terms of income minus expenses? What's your rate of return? Example, if you were to go to a bank because you wanted to deposit into a CD or whatever, what is the first question you're going to ask?
What's the interest?
That's exactly what it is. So here's my question to an investor who currently owns their properties. What's your rate of return? What are you getting back for all the equity when you consider all the expenses and the income of the property? And most investors do not have a clue what I'm talking about.
Yeah.
And I have a wonderful formula that we can give to your listeners if they're wondering what that looks like on their property. Because you know what I've noticed? The higher the equity, the lower the rate of return. Why? Because you can't charge more rent because you have more equity.
You can't charge more rent?
You can't.
Cannot.
Because
No.
equity is not,
Yeah.
rent is not based on how much equity you have in the building.
Right.
It's based on what's fair market rent
value.
for that particular property in that particular
Oh, I
neighborhood.
see. I'm
right?
thinking of people that have properties paid off and never really managed it well and didn't really get the right rents for it. So they have very low rent, but they're okay because it's paid off.
Yeah. Paying off is probably a good idea after you retire, because what's the most important thing to you? It's cash flow. So with no debt, you get to get maximum cash flow based on whatever you're going to charge for rent.
But that's not necessarily the highest rate of return.
But it's not the highest rate of return.
Right. You get more cash flow, but most likely your rate of return is minimal or
Right.
lower
For your equity.
for your equity, for the
Makes
amount of
sense.
money. Yeah.
That's right. Number two. And we've had a formula. Like I said, we've got a nice little handy-dandy flyer, and we had a couple CPAs help us design it.
Okay.
And it's fairly accurate. It doesn't include things like depreciation because everything is so, it can get too complicated. And that's when
Absolutely.
you have to go to a CPA.
Absolutely.
But for, layman use, it's perfect. Number two, the second thing they want is they want it to appreciate over time. The biggest regret investors have is that they wish they had bought another property, just one more, 5 years ago, or 10 years ago, or 15 years ago, or 20 years ago, because property values keep going up. Now, I know there's a lot of naysayers out there. So, property values are getting weak. I've seen markets where the properties crash. Well, let me ask you a question. It's summer right now. We're in July. What's going to happen in December and January? It's going to change to winter. We're going to go from summer to fall to winter. But spring comes back again. And so does summer. We're on a cycle. We have morning, the sun comes out. We have evening, sun goes down. It's a cycle. It's a rotation. The market rotates, but overall, even though the market goes down, it always exceeds the previous high, especially here in Southern California. So the bottom line is that the biggest regret most people have, people call me up, doesn't matter, New York, they'll call me from Ohio, from Washington, State, Florida, wherever, here in Southern California. They'll say, I need to set up a 1031 exchange. And I said, sure, I'd be happy to do it for you. And they're all excited. They said, I bought it for $300,000, it's worth $1 million now. And I said, congratulations. Don't you wish you had just bought one more? And that's exactly what they do. They laugh and they go, boy, do I wish I had. It's the biggest regret investors have, that they didn't take advantage to buy another property, more doors, to expand the more times they get paid every single month. And that's what investment real estate is all about. It's income, but number two, it's appreciation over time. You actually get to have your cake and eat it too, or your flan and eat it too. That
There
kind
you
of a
go.
thing,
I
right?
like it.
Good. Number three, tax write-offs.
Okay.
You want to go into a property that gives you income, better income with more doors, by re-leveraging the equity. Number two, you want to make sure that when the markets go back up again, and they will, just like the sun will come up tomorrow. I think Annie's saying that. But the bottom line is that all will appreciate, not just putting all your equity in one property, because you'll get more back from your appreciation by diversifying your equity into more properties. So when it does go up, you're going to make more money by virtue of the fact. And number three, you need tax write-offs. Now I want to talk about that. The more you make, the more the government takes. It's not because they don't like you, because we all have to pay taxes. But we've kind of come to the conclusion that that's fine. If I make more money, I'm happy to pay taxes on it. But then the government does something that is really bitter in the taste of, and creates a lot of, how can I say, strife and animosity amongst ourselves. They raised a percentage on you because you worked hard, you built the portfolio, you took the risk, you denied yourself for the sake of building this portfolio, and they say, okay, for your reward, we're just going to raise your percentage. Investors know 5 words. They've memorized it. They put it into their hearts and their minds. You know what those 5 words are? The government wants your money. And the bottom line is, the beautiful part about knowing, to answer your question even longer, people are looking for higher rates of return, but they need bigger tax write-offs because they need to keep more of the rent that the federal government wants to take away in terms of tax. And that's the third motivation. Can I go into better properties that will give me higher and better tax write-offs? They give us depreciation, which is a wonderful thing. They let us write off our property taxes, our insurance, any maintenance I do to the buildings. If I put a capital improvement into the building, which is completely different than a maintenance item, like for example, I add on or I upgrade or I start another depreciation schedule, like another layer of a cake. So now I have a second layer of a new depreciation schedule for that capital improvement, and it adds to my basis, which means it lowers my gain. So there's lots of incentives for doing these types of things with your properties. So when you want to go into bigger, better properties, so those properties will work for you, so you don't have to, that's what you look for. Those three items in the geographical areas in the markets you want to be in, and you can change that. If you're not happy with California, and a lot of people are not, they'll go other places. Since the pandemic, I have watched, and we're one of the largest independent exchange facilitators in the United States of America.
Wow.
25% of just my base has left the state in 2020. They did it again in 21. They did it again in 22. And they're still doing it in 23. Because if they can go into other markets where the rents are lower, but not that low, but the values are a lot less, they get a higher rate of return for their investments. Whether they're going into triple net, residential, whatever it happens to be. The bottom line is that you can do this like-kind exchange to defer tax to make the properties work harder for you so you don't have to. That was a really long-winded explanation.
Beautiful.
Excellent.
But that's really what it's all about. I mean, that's why people do this.
Yeah.
Excellent.
Anything else you want to add? And thank you for your time. No, that
You're
was
welcome.
a great explanation.
It's my pleasure.
Anything else you want to throw in, Dad, before we
I
wrap
love
it up?
talking about this. This is great information.
Yeah, you can tell you're passionate about
Oh,
it.
yeah, no. No, it's amazing. No, we're good.
We're
I mean,
good?
you have, yes. Excellent. Thank you very much for.
Where could people find you, Phil? We'll link on the description. What's the best way to work with you, to get a hold of you?
Thank you. The best is my number.
Okay.
My phone number is a good way to get a hold of me, and I'm really good about returning my calls as well.
Okay.
Though Verizon hasn't been so good to give me those messages where I have to go searching for them in the server as opposed to my phone, that's another story. I guess they're all sort of bad. And some, I don't know how we can send a people to the moon and communicate with them, but here on Earth, we can't seem to leave a message and let the guy receive it as on a timely basis. But that's,
Well,
I guess, another subject for another day.
It is.
But the bottom line is my phone number is the best way to reach me.
Okay, and I just got a new phone, and boy, was that a story with Verizon.
So what would you like to? We could put your phone number if you like. I mean, this is going public
Link
to
it.
the world. So
Mhm.
Sure. Area code 213-479-8800. The second best way to reach me is my email. And I have two email addresses. One is my corporate address, which is really long. It's patwan@exchangeresources.net. Most people prefer philatwan@gmail.com.
Okay.
PHILATWAN@gmail.com. Those are the two best ways. Yes, there's social media stuff.
Sure.
But honestly, that's my lifeblood.
Okay.
The phone and the email.
and we'll link it in the description both. Anything else you
Absolutely.
want to add, Dad?
No. It was a pleasure having you. Thank you
Thank
very
you for
much.
having me.
All right.
I truly have considered this a pleasure and an honor to be here with you today. And thank you
Likewise.
for helping us get the message out that investors can do just so much better. They can go other places. They can go into other types of properties within the like-kind description.
Right.
It is just a great world out there, even though the government, by the way, I hope your listeners will call their senators and their Congress people to tell them on the 2024 budget, vote no when it comes to the reduction of the 1031 exchange. All that's going to do is stifle the economy even further.
It's a great
Excellent.
message. Yeah.
Good point. Excellent.
All right.
All right.
Thank you, Phil.
Welcome.
Thank you.